Hey everybody, Nathan here again, and wanted to answer a question that we had received this morning on Facebook. And the question was, what is the difference between a fixed rate mortgage and an adjustable rate mortgage? And I want to talk about that just for a minute. So we'll start with the easy one first. The most common program that is done when we talk about a fixed rate versus adjustable rate is the fixed rate option. And the nice thing about that is on a fixed rate program, once you have an interest rate locked in and once you go to closing and that rate is on your closing disclosures, that will stay your interest rate for the life of the loan. So whether you do a 10-year mortgage, a 15 or a 30-year, your interest rate is always going to be the same. So let's say, for example, your interest rate is 4% when you go to closing and you sign on the dotted line to get your paperwork finalized and everything is completed. That 4% will always be your interest rate. So that means your payment will not change throughout the life of the loan unless your taxes or insurance goes up or down. So your actual principal and interest piece of that payment will stay the same. Escrows can always change, but that principal and interest will stay the same. And that's the most common right now. With interest rates as low as they are, fixed rate is basically, I would say 80 to 90% of the time the best option right now. Now, an adjustable rate mortgage is something a little different. It's fixed for a certain timeline, and then it will adjust after that timeline has expired. So an adjustable rate mortgage, also you hear it commonly referred to as an ARM mortgage, and just the abbreviations for that. But what happens is you can set up a varying numbers of years as far as how long that would be fixed, and then it goes adjustable after that. So for example, you could have a 1-year adjustable rate, 3-year adjustable, 5-year, 7-year, 10-year. And what that means is during that 1, 3, 5, 7, or 10 years, that interest rate is going to be the same. And then after that time period has elapsed, then the interest rate will adjust based on what the market is doing at that time. So based on what the bond market and basically what it's doing along with Wall Street and different things, all that kind of ties together to determine if your interest rate after that fixed period will go up or down. Now, believe it or not, over the past few years, with interest rates being where they were, several interest rates on adjustable programs went down. But now that we're into a market where interest rates are starting to inch up a little bit, then you'll see that adjustable rate mortgages will, once that time period elapses, then those rates will go up as well. So one of the main reasons why an adjustable rate mortgage could be good is if, let's say you did a 7-year ARM program, you would have a low fixed rate for 7 years. Of course, it would adjust after year 7, but if you thought that you were going to move within that 7 years, let's say it was a temporary house, you were just going to stay and you and your family were just going to stay there for 3 to 5 years, then it may make sense to do an adjustable program. But for the most part, that's kind of, I think, a rare situation. Most people kind of think they're going to be in their house a little longer, even if it doesn't end up that way. A lot of people still feel like a 30-year loan or a 15-year loan is how long they're going to be in that house. So anyway, that's something to keep in mind, but that is the differences between the two. There's not a lot of adjustable rate mortgages out there right now. And like I say, as interest rates start to go up, those may start to become more and more popular down the line. But I just want to kind of explain those two options to you. If you have any other questions, feel free to message me. You can click on the link below if you're thinking about getting approved for a mortgage. We'd love to help you with that, and we can talk more about different loan programs and different options that you'll have at that time. So thanks again, and have a great day.